Hi, this is Mr. Gideon. So now I want to talk about monetary policy, which has to do with trying to stabilize an economy using the banking system. Different strategy and different tools compared to fiscal policy that uses the means that are available to politicians. In the case of the United States, we're talking about Congress and the President to stabilize the economy. And namely, those tools are adjusting the level of transfer payments, adjusting taxes, as well as expenditures. Uh, and these two arms of policy are not mutually exclusive. In the case of many countries recently, they've had to use both arms very vigorously to try to prevent economic collapse or try to get themselves out of a severe and deep recession. And this applies to us, of course. But a lot of monetary policy focuses on money, the use of the money supply, and the banking system. And banks are a part of a larger financial system, so before we dive into that, we have to know certain basic terms that apply to the financial system. First, financial intermediary. This is an institution that transforms funds gathered from many different individuals into financial assets, and then they use those assets in different ways. Examples are mutual funds, pension funds, life insurance companies, and of course banks. In the case of banks, if they are going to offer a loan to someone out of the savings that they've accumulated, they're going to charge a price for that, and that's known as the interest rate. National savings is the total amount of savings generated within the economy, no matter which economy we're talking about. Capital inflow refers to financial capital. If you recall, when we talked about the factors of production, when it came to capital, there were two kinds, physical and financial capital. And this refers to financial capital flowing into a country from another country, investors from another country. Financial markets are where households invest their current and accumulated savings, also known as wealth, by purchasing financial assets. So what are financial assets? These are paper claims that entitle the buyer to future income from the seller. What are the kinds of assets that can be sold? Well, four common types are stocks, bonds, loans, and bank deposits. We'll be talking about these last two quite a bit in this unit. An asset is anything that you own that is worth money. So in the case of a loan, if you're a banker and you give a loan to someone, that's an asset because that's a moneymaker for you. When you charge interest, that's the method you use to make money on this. It's not an asset to the person who's taking the loan. It's an asset to the institution or the person who's offering the loan. So we'll talk later about how that's reflected on a financial document known as a T account, which is a simplified balance sheet. But that's an example of an asset. A bond is an IOU issued by the borrower to the lender. And if you happen to own a bond, really, the way you should think about it is not that you necessarily own something other than that paper claim that we're referring to in this grouping of financial assets, but what you've done is you've loaned to some entity an amount of money that they agree to pay back to you in the future. Maybe you didn't buy the bond, maybe you own it because an aunt, an uncle, another family member bought it for you as a way to pay for college or as a savings vehicle. But in reality, that's what a bond is. And that's really important to understand. A bond is a type of loan, and it's issued by companies. There are such things known as corporate bonds, but the way that we're going to be referring to it most often is through government issue. So local, federal, and state governments all issue bonds when they need money and they don't have the money already sitting there. Typically it's because they have a deficit. And there are three parts to a bond. The base amount of the loan is known as the principal. The interest that's agreed to be paid on that loan is known as the par value. And then there's a maturity date or a deadline by which that loan is agreed to be paid back. Now, of course, not every person who ever takes a loan out, bond or otherwise, makes all the payments on time. And this can go for governments, not just individuals like you or me. So if somebody defaults on that loan, on that bond, what we're basically saying is that they failed to live up to their side of the agreement. And default is a risk that the bond issuer might fail to make payments as specified by the bond contract. That's something that at the time of this recording is a major issue in the news. in the summer of 2011. In the case of Greece, in the case of the United States, people are debating whether or not these countries, if and when they default on the outstanding bonds they've issued, is going to lead to a major economic crisis and a financial crisis, both within those countries and perhaps other countries that are connected to them. But that's what default is. Loan-backed securities are assets created by pooling individual loans and selling shares in that pool. It's also known as securitization. So you could have a bank, and this was done quite a bit recently in the United States. You can have a bank that issues a whole bunch of home loans, and then they take those loans and say, you know, we're not going to wait 20 years or 30 years for our customers to pay us back directly. We'll sell these loans to some other company, and that company can bundle them together, which is called securitization, and create a pool of loans that other people invest in. But these are securities that are ultimately backed by loans. Whether they're home loans or some other loan is a different issue. Stocks are a share of ownership in a company. So if you own stock or somebody else owns shares of stock, essentially you are a part owner, probably a very small, you probably have a very small share compared to the other people that have shares in that company, but nonetheless you're considered an owner. A physical asset is a claim on a tangible object, something that's physical and tangible, such as a pre-existing house or a piece of equipment. A liability is a requirement to pay money in the future. So the way to think about that is something that you owe. An asset is something that you own. A liability is something that you owe. For example, a loan, if you take that loan from the bank that we mentioned before, it's considered an asset for them, but it's a liability for you. So with a little bit of this in mind, what are the tasks of the financial system? Why do we even have a financial system? Well, one reason is to reduce transaction costs. These are the expenses of actually putting together and executing a deal. In theory, when you have these financial intermediaries, they can efficiently put together deals and make it a lot easier for them to be enacted, these trades, particularly in the financial area, as opposed to people like you and I trying to put together the same deals on our own. Another task of the financial system is to reduce risk. Risk, particularly in this case, referring to financial risk, is uncertainty about future outcomes that involve financial losses and gains. So the system's supposed to reduce risk. It's also supposed to promote diversification, or investing in several assets with unrelated or independent risks in order to lower the total risk. So for example, mutual funds. A stock mutual fund is one of many types of mutual funds. Bond funds are other kinds of funds. But mutual funds are supposed to follow this principle of diversification and lowering risk, where they take money from thousands of investors, put that into one pool, and that pool is managed by a team, a professional management team, that says, okay, well, we're a stock mutual fund, and according to our investment goals, the goals that we've published out there that have caused investors to trust us with their money, we are going to invest in a whole bunch of different stock from different companies. Because if you put your money into 2 or 3 companies and their stock, and those 2 or 3 companies take a nosedive, so does your money. But if you spread your money out amongst dozens or even hundreds of different companies, then in theory it would take the entire market to have a major drop for you to have the same kind of loss. So that's one example of diversification. Another task of the financial system is to provide liquidity. Liquidity meaning a degree to which an asset can be quickly converted into cash without much loss of value. There's a lot of different places you can put your money. You can literally take your cash, your currency, and keep it in your house. That's very liquid. It's easy to access and use for so many different kinds of transactions. Then there's other places you can put that money, which may or may not be a good decision for you depending on what you need your money for. And depending on where it is, it might be difficult to get your hands on. If it's difficult to get your hands on, and if you have to even pay a penalty to get it from some other location to use as currency, then it's not as liquid. So keeping this in mind, of course, a bank as a financial intermediary as part of this financial system, is supposed to be serving these kinds of tasks: to reduce transaction costs, to reduce risk, and to provide liquidity. And so how does a bank do this? It accepts funds from depositors like you and me, who act as lenders, who receive credit for a bank deposit and interest. So when you put your money in a bank, and we're not talking about taking a loan from the bank, we're talking about the other side of the ledger now. You put it in a bank account, savings account, checking account, or both combined, because now banks can pay interest on checking accounts. We're actually acting like a lender. Now, we don't make much money. I don't know what you're getting today. It's probably 1 or 2% at the time of this recording, if you're lucky. That's how much you're getting paid as far as savings go on your savings account with the bank. But the bank takes that after they pay you, and they use that money to make money on the loan side. Banks only keep a fraction of those deposits in form of cash, though. Most of the deposits are lent out to businesses, buyers of homes, etc. Banks count on the fact that only a small fraction of the depositors are going to want their cash out at the same time. Otherwise, we could have what's called a run on the bank. But if that was to happen, and this was recently an issue in 2008, each deposit is backed up to $200 by the FDIC, the Federal Deposit Insurance Corporation, which was established in 1933 after a few years of runs in the United States on banks that caused a lot of pain and turmoil. This was through the Glass-Steagall Act, also known as the Banking Act, to combat the Great Depression. So a little bit about the financial intermediaries out there and where banks fit in.